Good afternoon, everybody. Welcome to AI Innovation for Compliance and Competitive Advantage webinar with Capco and SolasAI. My name is Josh Siegel. I'm a partner in Capco's banking and payments practice. Been doing this for about 25 years, assisting financial services companies as new technologies are introduced that they have to master. Sometimes these new technologies that banks have to master, it's not always that banks want to master them, but the market demands it. And it's the same for AI. Customer expectations, commercial relationships, expectations are changing, and banks have to change with their customer expectations to stay competitive. And just like everything else, it has to be done in the right way. Capco's really focused on the power and the potential of AI across financial services, especially in banking and especially in lending. But where there's power, there's also peril. And we're really excited to be in partnership with SolasAI. Together, both of our companies bring, we think, a leading solution to this space so that our clients and Solas's clients together, banks of all sizes in the US, can harness the power of AI and do it in the right way. Make sure their clients and their customers continue to maintain trust with their institutions and that they get both the competitive advantage and compliance out of those solutions. Thanks for being with us today. I'm going to turn it over to Lindsay Toller with Elasticity, who's going to be our moderator today. Lindsay.
Thank you very much, Josh. I am very excited to be here. My background is really not in AI and technology, so consider me a noob. I may be interrupting you guys to ask, what exactly do you mean by that? Can you explain that, please? I want to reintroduce Josh because he's going to be a big part of this conversation. Josh Siegel, boasting 25 plus years of expertise in business strategy, application design, and data solutions. He's excelled in banking, finance, and insurance across North America, Europe, and the Middle East. Formerly at PricewaterhouseCoopers, Bearing Point, and Dell Professional Services. He is now a partner within Capco's banking and payments practice, contributing his wealth of knowledge in digital transformation and process improvement to our discussion. Please welcome Josh. The next panelist I'd like to introduce is Larry Bradley. Larry is a technology veteran with 30 plus years of leadership experience in emerging and established technologies. He's guided Fortune 50 to Fortune 1000 companies in adopting big tech, machine learning, and organizational transformations with leadership roles at Hitachi Vantara, Reen Cloud, Centara, and Gartner. Larry has also advised the US government on IT technology. He's now CEO of SolasAI, pioneering bias detection and leading companies worldwide into the AI and machine learning era. So thank you for joining us, Larry. Our next panelist, introducing Brian Hughes, a distinguished senior executive and advisor with a remarkable 30 plus year journey in financial services and consulting. Brian's extensive background as a Fortune 500 chief risk officer, credit card CEO, marketing EVP, and strategy consultant equips him to expertly balance growth and risk. Looking forward to talking more about that today. His expertise lies in crafting innovative strategies, cultivating high-performance teams, driving business transformation, and achieving lasting growth. Thank you very much for joining us, Brian. Last but not least, I'll introduce Jana Miles. Jana is the General Counsel and Head of Regulatory Affairs at the American FinTech Council. She leads innovation in lending, corporate governance, and regulations. Previously, Jana served as Senior Counsel on the House Financial Services Committee. Her experience also includes roles at the Center for Responsible Lending and the Fair Housing Project of the Washington Lawyers Committee, as well as staff positions with the House Democratic Caucus on Capitol Hill. Jana, thanks for being with us today. Okay. There is a lot that we would like to talk about. And when it comes to AI, it feels like that conversation can go in any which direction. So I'd like to talk about three general points we're focusing on today. So as you hear these, please get thinking about any questions you want to ask to our panelists, to the group. We'll be doing Q&A at the end. Your questions are very welcome. So today, what I'd like to talk about is identifying pain points when utilizing AI for loan decisions. Second thing, leveraging AI to gain a competitive advantage. I feel like that's something that all businesses are looking to talk about, and the conversation about that is wide open. And then another thing I'd like to talk about is AI creators versus AI consumers. What do we have in common, and what do we need from each other? With all of that on your brains, the first question I'm going to send to Brian. Brian, what steps can lenders take to fully maximize the potential of AI in loan decisions?
Yeah, so I'm familiar with the question because it was something that I dealt with as a chief risk officer. We wanted to leverage AI in our loan decisions, and we successfully made that journey. And to our benefit, we saw 10 to 30% reductions in losses without any decrease in new accounts for making that journey. And I would break it down maybe into three hurdles that we overcame. The first was just getting the data and the tech we needed to create and deploy the better models, right? So if you're going to use AI, the development platform, the decision engine you use, the way you curate the data, there's sort of a technical element to it. The second thing we had to do is we had to bring in the right team, not only versed in AI, but also versed in how to build the models. Those are the model developers. But then we also had to work with the rest of the teams inside the organization, the risk teams, the data teams alike, to be able to support that. So number one, data and tech. Number two, the people. And then number third was the risk side. As you know, this is an area of big regulatory focus. It's an area where if you get it wrong, you can not only run afoul of the regulators, but run afoul of your customers, possibly your employees as well. And so we had to make sure we had the compliance and regulatory side of it right to ensure that the AIY was fair and explainable. And we worked with some of the founders of SolasAI, which is why I'm here and I'm so enthusiastic about the offering that they provide.
Thank you, Brian. Fair and explainable. I think that we're going to talk a lot about what that means and where we're going with that today. Larry, can I talk to you? Given its power, can AI be used safely to make lending decisions? And then where does SolasAI come into that when it comes to, especially when it comes to addressing unintentional bias? But let me start with, can AI be used safely to make lending decisions?
Thank you, Lindsay. I do think that AI can be used safely in lending decisions, and especially if there's enough validation, explainability, and transparency, built into both how you create the model and then testing it before it goes into production. The challenge there can be that a lot of the tools that are available are either very generic, they still require a lot of manual effort, or in some cases they trap the customer in proprietary technology. There's also, in many cases, a big gap left with what to do with any problems or challenges you find. And so that's one of the areas that we've focused on trying to fill that gap. Where I do think that financial services is ahead of many of the other industries, and especially in lending, is that there's already a very strong framework built by the model risk management regulations as well as fair lending. So, there's already a very strong foundation for lenders to build on and to continue to add sophistication into that. Now, one of the challenges is adopting newer forms and more complex forms of AI, and will the tools to manage that provide trust and transparency into that? Will they lag behind, and will that slow lenders' ability? So I think those are some of the key questions. But of course, that's also, the opportunity that we at SolasAI are trying to help with is being able to provide a very specific set of capabilities to look at and help you understand, what's happening in your models from a fairness perspective. And it's important because that's both an important area to focus on, but also a high risk area to focus on as regulators are keeping a close eye and putting a lot of focus on that. And so that's what we did, is we created SolasAI to do that. And the last piece is that, with so many of these models, one of the things that people don't understand is that they're usually, anywhere from thousands to millions, and in some cases billions of alternatives for the model that the customer chooses. And that creates both a challenge in the fact that how do you sift through and decide which one to go with, but also an opportunity in the fact that it does mean that you can still find very high performing models that improve on other dimensions like fairness, and be able to do that while still competing successfully.
Using AI to find AI to improve AI.
Yes, that's exactly what we're trying to do. Yes. And I think that's what is going to need to be done. There's no way that regulations are going to solve some of the risks and challenges with AI by themselves. People can't do it by themselves. And so we will need to have AI helping us manage, understand, and be able to optimize AI.
Thank you, Larry. I want to ask Josh, what is Capco hearing from its clients on both of these topics? You mentioned the power and the peril of AI in your introduction. What advice do you give your clients?
I think we're hearing a lot of excitement, Lindsay, from our clients generally about the power of AI to improve their business models, how they interact with their customers. Some of our clients are really interested in how they can take cost out. Some are interested in how it can improve their customer experience, how it can streamline processes that really need to become more efficient. It can identify offers for customers that will improve their value proposition to the bank. So there's a lot of focus on the potential of AI. A little bit of FOMO, probably fear of missing out, right? This is a huge tech trend globally, and banks are not unlike any other industry. This has the power to fundamentally transform their interaction with customers and their business model. And banking is one of the most regulated industries in the world, and you can't just apply AI and see what happens. And so our customers are coming to us, our clients are coming to us and saying, how can you, Capco, help us ensure we're not missing the boat? How can you help us prioritize how to best spend our budget, which isn't infinite? Where do we apply AI? How do we get the most out of it? And how do we get ahead of the regulatory community, who many of you on the webinar may have seen just yesterday? The CFPB issued new guidance on the use of artificial intelligence. These are coming every day now. And we are therefore telling our clients solutions very similar to the one that Capco and Solas have created together, which marry the capability, the power, the potential of AI with an ability to keep it not necessarily under control, but to allow a bank to explain it, both to its customers and to regulators. That's the way to win for clients going forward. And whether it's this solution or another solution, or looking at the processes of the data behind the lending function at a bank, banks need to get on board with the AI revolution and control it when they do it.
I want to say to the folks listening, if you have more questions about the CFPB news or what's going on with our regulations, we are taking questions. We'll be asking them to the panelists at the end of this conversation. So I encourage you to submit some questions if you're interested. Yana, can I, since we're talking about regulatory stuff, can I ask you, what do you see as the regulatory impact of what these guys are talking about when it comes to responsible banking? How do you see the regulatory environment evolving there?
Well, that's a part of the push and pull, because we are in an area of AI. We're in an area where AI is being used in a number of decisions, lead generations, credit decisions, and we're in a place where a lot of the regulations, in my head, the 1990s were like 10 years ago, but Gen Z reminds me that it was much longer than that. And so I'm aging myself here. But, we're in a place where our regulations on paper are, up to 30, 40, 50 years old at this point. And the regulators, this won't be a popular opinion, but regulators are correct to want to understand these markets. They're correct to want to understand how these processes work. I think, and how I see it evolving. I mean, Josh stole a little bit my thunder there on referencing, but it's a big deal for anyone to mention the CFPB guidance that was released yesterday. This guidance, and happy to talk more about it. It focused a lot on, we talked about explainability. And I think this is where regulators are going to be, I think, laser focused. The CFPB, we've heard from Michael Barr at the Federal Reserve and other spaces. We know that on the congressional end, Senator Schumer, Leader Schumer, is leading dialogue on AI. And I'll say that in terms of where I see it evolving, I think there's going to be a lot more questions and a lot more scrutiny about how these processes work, how algorithms work. I know we're going to talk a little bit about algorithmic bias and addressing those pieces. And I actually think that it's right for regulators and lawmakers, policymakers generally, to want to better understand how these processes work. And I believe I didn't fully answer your question. If you wanted to repeat it, if I didn't, I'm trying to keep an eye on the clock.
No, I really appreciate your answer, because the importance of regulators keeping up with it brings to my mind, I mean, AI is sort of inherently difficult for humans to wrap our minds around, and it feels like we're at this like breaking point of new things coming. So I do want to ask Brian, can you give me an example of a better decision AI makes as it relates to lending and the competitive advantage?
Yeah, sure. So the easiest one to point to in terms of decisions on credit is, do you get credit or not, right? So it's that approved decline decision, probably the biggest decision you make when giving a loan. And as I spoke about earlier, when we made the transition from logistic regression models to models developed using traditional techniques for logistic regression over to machine learning models, saw reduction in losses of 10 to 30%, which is massive compared to all the other improvements we've been making on our models. This is a step change improvement, and no reduction in new accounts. You could flip it the other way. You could say, keep my losses steady and give me a growth increase. We decided to reduce losses. So that was a substantial difference. 10 to 30%. It differed by product. It sort of differed by customer segment. But sort of a massive difference in the results. And I think that you could look at all the many decisions across the bank, but many decisions within lending. The same could be done for determining the size of the loan, determining the pricing of the loan. I think equal gains are possible through the use of machine learning for credit decisions.
Thank you, Brian. Larry, I want to send you a question that's this: what sets apart AI creators from AI consumers, and how does this impact the evolving technology landscape?
Sure. One of the things we're seeing in the market is that it looks like there are two major strategies that people are starting to follow, and it's more of a continuum. But there are many organizations that are looking at AI as something that they want to use to compete with, but rather than try to create it themselves, what they're really focusing on is being great consumers of AI and being able to source AI from others and then integrate it into their business processes, like their lending decisions. And so, that's one sort of extreme. The other extreme is we want to have AI be a competitive advantage, but we really want to be creating that AI and build it ourselves so we have greater control over it, and that they have some belief that their understanding of their business, the amount of data they have, that by creating the AI themselves, that's going to help them compete more effectively in the market than consuming somebody else's AI that they created and then just running their data or decisions through it.
Will there be
so,
a lot of,
yeah.
I wanted to ask, will there be a lot of folks who are both AI consumers and creators?
Yes, and that could even happen in different business units. And so what you will do is, like in customer support, you might see more consuming AI, but then, in the lending group, they might focus more on creating AI themselves. But then there are other organizations that it's going to be more more enterprise-wide, that whether they build or consume. And we're already starting to see this with companies standing up AI-focused governance bodies within their sourcing group to help them make those decisions. Is this something we should buy? Is this something we should create? And then how does that get rolled out across the organization? But each one has its own risks associated with it. And so, as you're creating AI, you're going to have those tools that help you really understand the decisions you're making from both a technology and a data perspective, but also the decisions that you're going to be using. You're going to be making using that AI. Another big piece is, and one that we see catches people fairly regularly, is creating a model for one particular purpose, but then somebody says, hey, that's great, I can use it for this other decision. And then all of a sudden, the validation and the testing that went into that first model, it may not, that first business process, it may not transfer to the other one. And so you have seen issues there where algorithms were built for one particular purpose, they did that well, and they did not have bias in them. But then as soon as they started getting used for another reason, all of a sudden it started causing massive problems with bias or just less effective decision making.
Thank you, Larry. I think that's a really great example of one of the problems that can come up that maybe we weren't anticipating. I want to remind people, we've gotten a couple of great questions in the chat, and if you are listening to the webinar and you have a question for one of our panelists, please post it. I'd be happy to ask it. Talking about those changes in business processes, Brian, I'd like to ask you the question: what specifically are the regulators focused on when it comes to using AI for lending? In your previous role at Discover, can you describe some of your specific challenges and how you address them, and how focused should banks and lenders be on this issue?
Yeah, so maybe I'll start with the last part of your question first. How focused? A lot, or very, I would say focused. I think there's a rare moment for the regulators, and that I think every regulator in their list of priorities has fairness and use of AI on the agenda. Even the White House talks about digital redlining. So it's at the top of virtually every regulator's. It's in the top 3, top 5 of every regulator, and that's pretty rare. And like we talked about, the CFPB just yesterday, issuing more guidance on AI, and there's more coming. But I think if you look at sort of what do you have to care about now in financial services, for making sure that you follow the regulatory guidance and that you are fair to your employees and your customers, I'd say 3 things. First is fair lending, and this is really where Solas excels. You've got to do a few things for fair lending. Number one, obviously, you can't use protected class variables in your models like race, right? That's an absolute no-no. But also, you can't have anything that proxies for things like race or age in your model as well. That's disparate treatment. So that's first part of fair lending. Second part of fair lending, disparate impact. This one's a little bit even harder to comply with. This says, okay, so you don't use race or proxies or any of that stuff in your model. Yeah, we get it. But you still, though, if you have a disparate impact, if you approve more whites than other races, or if you approve more younger people than older people, you can still be out of compliance. And what you have to show is that there is no less disparate means to achieve the same level of effectiveness as what you're doing. So you can approve more younger people than older people, and you can approve, more whites than other classes, but you have to show that there is no other way to do that that's as effective as your technique that sort of limits the disparity. It's you actually have to prove a negative. It's a tricky one to comply with, especially when you have AI. And that is where I think Solus really excels. We can talk about that one a little bit more later. So there's fair lending, number one. Largely, you can get through fair lending through some deep testing of the AI that you're deploying. And again, that's what Solus excels at. You test it before you deploy it. You test it after you deploy it. Second is adverse action. So if you're going to turn somebody down for credit or give them a less favorable outcome, you have to explain to them why. There are a lot of tested techniques that can be used for existing non-AI models. They can also be used for AI models to try to tell a consumer why they were turned down. It's trickier in an AI model because you tend to have a lot more variables at play, right? So what's the particular reason this particular consumer got turned down? And is it the biggest reason or not? However, there are good techniques that can be used for AI, a lot of good white papers out there to use them. So adverse action, number two. And then third is model governance. The guidance on model governance, SR 11.7, it talks about how it's the regulatory framework for model validation and monitoring, lays it out for how do you have to test your model, how do you have to monitor your model over time to make sure that it's making good decisions still. So those are the three big existing pieces of regulation. There are proven techniques for dealing with each one of them. So it is possible to do this in a compliant way. And by doing it in a compliant way, you're doing it in a fair way as well, fair and safe way for your company, for your employees. And certainly if we want to double click on why I'm so enthusiastic about the Solus approach to fair lending, we can. But just to mention a couple things in that it is really well aligned with the regulatory guidance, the letter and spirit of the regulatory guidance, and it is really transparent. So what I like about it especially is that idea of showing there's no less discriminatory means to achieve the same outcome. That's where Solus really excels, because they will test thousands and thousands and thousands of versions of your model to make sure and help you find the best model with the least amount of disparity in it, and that's why I'm such a fan.
Jana, Brian was talking about fair lending, adverse action, and model governance as the places where banks should be focused. Is that where regulators are focused?
Yes, just to reiterate, I mean, every point that he just touched upon is addressed in the guidance that the Consumer Financial Protection Bureau released yesterday, and the factors that they're going to be looking at. It's extremely important, and it really, again, just transparency, explainability. It really just goes back to that first phrase, the top of this webinar. Another thing, I think the way you laid out disparate impact, it makes sense, and I'll also add, intent is not a legal consideration in disparate impact. So being able to say, well, this is the algorithm, this was a machine learned decision, and therefore there's no intent. Well, the law says, at least for now, the law says that's not a consideration. So it's really important, especially with the increased scrutiny that is here and is only going to intensify from regulators, for lenders, banks, other institutions using AI models to be able to explain how the models work, how the algorithm works, and not to reiterate too much what was just said, but just generally to be being able to explain how it works. A lot of things that we're hearing about, I mentioned this before, algorithmic bias. There is a saying that we hear from. I'm coming from the consumer advocacy world, even though I'm not there now. What you'll hear often is garbage in, garbage out. So you can say something is artificial intelligence or machine learning, but if there's a disparate impact that's very obvious, and it will show and be obvious in terms of approvals, that's something that is gonna draw negative attention to that particular institution or practice. So it's really important to, just keep that in mind. I think people look at some of the regulators and say, well, they're against innovation or they're against AI. And I think really, we're coming out of, I guess this was actually about a little over 10 years ago, the Wall Street crisis, the 2008 crash. We're coming out of a period where, regulators were looked at as asleep at the wheel, and not paying attention to the impact of emerging markets and emerging products and mortgage lending. They were accused of being asleep at the wheel for the disparate use of certain mortgage products in Black communities, Latinx communities, and data showing that many of the folks that received some of these subprime loans were people that actually would have qualified for more traditional products. So we're in a space now where regulators are paying very close attention to emerging markets, to emerging practices. They, as oversight over the market, they do have a charge to get a sense of what is safe, get a sense of what's sustainable, and get a sense of what's fair and what's abiding by the law. And we've talked about this, but the Equal Credit Opportunity Act, ECOA, this was another law that was referenced by the Consumer Financial Protection Bureau in its guidance yesterday, and other regulators, as to how AI plays in. And ECOA is something that is still taking, in my opinion, as it should, center stage as to how credit decisions are made.
And going back in time even further from the Wall Street crash, I could think of plenty of times when there's just a secular nature to markets, right? I remember the dot-com bubble before that. I remember the savings and loan blow up before that. And just to mean this like ebb and flow of regulation and innovation and pushing and coming back down. But I feel like artificial intelligence adds a whole new level of complication and adds a whole new level of just the opposite of transparency. Is that, Yana, do you feel like regulators are ready for that?
I think that they're nervous about that. I mean, I think that that's fueling a lot of the inquiries and discussions and guidance and upcoming rulemakings. I mean, the other piece is, AI is likely going to have a role in a lot of major rulemakings coming up, particularly from the Consumer Financial Protection Bureau. We've got the data, we've got data privacy. AI is going to play a space there. We've, Section 1033 of the Dodd-Frank Act, that rulemaking is, the proposed rulemaking is looking to drop next month in October. I believe, AI, and again, just data gathering, and data use, data sharing. That's gonna play a role. We know that the CFPB is also looking to evaluate, the use, data brokers in terms of credit, and looking into the Fair Credit Reporting Act in terms of modernizing that. That's another, that was what I was thinking as one of the major pieces of statutory law that is showing its age a little bit, and the Bureau is taking a look on how to modernize that. And the use, the promise, of AI in a lot of these situations is, we want to expand credit. We want to include alternative data. We want to, include a bunch of things that traditional sources of credit decision making have not, been charged as using as well in the past. And so they're looking into the future. But I think, again, going back to, like you said, all of the cyclical, moments in our economy, and they're paying close attention to avoiding those things, and ensuring that the law gets updated, but that current laws are not being skirted by innovation.
Thank you, Yana. I want to start pulling questions from the ones that are submitted by our webinar viewers. So I just want to give one more plug. If you have a question about what we're talking about, or you'd like to talk about anything regarding AI, how we're using it in loan decisions, how we're leveraging it for competitive advantage, the difference or symmetry between AI creators and AI consumers, I invite you to put your questions in the chat. I want to start with this one, and I want to send it to Brian and Josh. From Julio: how should we be upskilling banking professionals in AI?
Yeah, so I'll take a first shot, but or Josh, you want to go first? Sorry. with your analysis.
I think I'll answer the following way, and just following the discussion that we've been having, Brian and Yana, your comments, right? Despite whether you're a creator or consumer of AI, it is increasingly clear that AI has to be a core competency within a bank. You have to know what it is. You have to know what affects it. And we've been talking a lot about model bias and disparity. Those models are based on data and processes, and those application processes, the data that's gathered and curated and governed on which the models are based, all of that really by extension is a part of this decision that it isn't just good enough if it's fair. You have to prove that it's fair. And so banks need to upskill data professionals. They have to upskill product owners. They have to upskill technologists. They have to upskill data scientists, each in their own way, so that everybody has an understanding of the interplay among all of those components. And they understand really both sides of that coin, right? Both how to either create or consume AI, but also how to make sure that it's operating fairly and how to prove that it's operating fairly. And lastly, I'll just say, since I have the mic, so to speak, we're talking a lot about lending, but of course, AI applies and is being applied to decisions that financial services institutions broadly are making that elevates one person over another. That could be insurance underwriting. It could be the designation of a fraudulent transaction. It could be whether you get an offer of employment. There's all sorts of ways that AI can seep into and apply. Lending is a very important and strategic and relevant area, but it's not the only one.
Yeah.
Thank you, Josh. Brian, Brian, can I get your take?
Yeah, I would tag on. I would say, when you talk about upskilling banking professionals, I would divide banking professionals maybe into three buckets of employees. One, builders; two, users; three, protectors. And then even within each one of those buckets, there's sort of, different groups. Just take the builders, for instance. Your builders are going to be the people actually, creating the AI for the organization, or acquiring it, so they'd have to understand it really well. But then also the builders might be the people staging the data, or the people sort of deploying the technology. So I think for the builders, back to school, some of them, in terms of taking specifically designed courses for working professionals that can, say, teach the modeling techniques associated with AI, or teach about the data technology platforms. Those can be through education associations, universities. Also, a lot of the providers, leading providers of some of the AI packages, also offer sort of courses for builders. When it comes to the users, I would get much more applied, thinking about what to do with the users, and focus the users on the applications of AI in their area. So, for example, leaders of customer service learn about AI chatbots. Leaders of marketing learn about how AI is being used for copy development, customer communications, marketing communications development. So I would say you want to focus on very specific use cases to know where it's being used beneficially. And then lastly, the protectors, the risk teams in the organization, a little bit of both in terms of education curriculum. So the model risk management team that was under me, my prior employer, we actually sent people back for coursework so they could understand how the AI worked. The compliance team, we worked with the American Bankers Association as well. So I think two things in summary. Number one, separate out your employees, profile your employees. And then number two, think first about what exactly you want them to learn, so that you know what you're hunting for, because there's a cajillion options out there for AI education. A lot of people willing to take your money.
Thank you. Thank you guys for making that very concrete for me. This is all, AI can sometimes be kind of nebulous and in the cloud. So that helps a lot. Another question that has come in from Bernardo that I really liked is, how will AI help dealing with transparency and ethical dilemmas? And I wanted to ask this question to Larry, because maybe unfairly, I've been thinking of AI as an obstacle to transparency. How will AI help with or impact transparency in big decision making?
I think it's going to be critical for that. I don't think you can get transparency into AI without really using, other forms of AI and algorithms. And so, from our perspective, one of the challenges is really understanding what's happening inside of those opaque models. And so being able to use one AI to look inside of the model, understand what's both driving the value in the model, but also driving the negative aspects, in our case, the unfairness or the bias, being able to understand how those different relationships play off of each other. And, in the world of statistics, those are usually a very small number of relationships and interactions. The problem with AI is that those relationships and interactions, they can be on an astronomical scale and be very hard for a human to really understand what they are. And so you need an artificial intelligence, or you need an algorithm to be able to look in and really understand what's happening, and then be able to communicate that back out to the people who need to make the decisions. Because the decisions and the judgment are still something that the humans have to make. And so we need these virtual AI assistants, whether it's a virtual AI fairness assistant or virtual AI fraud assistant, to be able to understand like what's happening in your models, and then to give you the information you need to make good decisions about it. And even that who needs to make that decision, one of the things that we solved for is that modelers, lawyers, and compliance people may all speak very different languages. How do we provide them a single source of truth so that they can really make that decision in a collaborative way, and in a way that helps them build their business, not just creates tension?
Brian, it seemed like you had agreed with some of that.
I did. I think, the interesting thing about AI is that I think we have more transparency. We can get more transparency today into what an AI model is doing and understand it better than we could with the models that we had before AI, because we're using AI to explain AI. You can use AI to explain, the old models, the non-AI models as well. But the amount of transparency we can get, the understanding of what's going on in the model using AI to understand AI is better than we've ever had. And I think that therein, I think, lies how you unlock the promise of AI without the perils, is by, to Larry's point, getting the transparency, using a package like, using a provider like Solus to help you, and then putting that transparency into the hands of decision makers, so they can use it to make the right choices.
Yeah, I want to just tack on to that. I fully agree with Larry and Brian. I think that I know we're focusing a lot on lending and credit decisions, so I'm going to be guilty of keep doing that. When we're, there have been studies from the past 5 years of people that have gone into, and I'm not here to diss traditional forms of lending at all, but they're studies of folks that have, prospective small business owners, people looking to take out small business loans or personal loans, or going in and looking into mortgages, looking to be first-time home buyers. There have been, the National Consumer, the National NCLC, National Community Reinvestment Coalition, NCRC, and others have done a lot of very recent studies showing discouragement. And this is so, like, speaking to transparency, you know, previous models or previous forms of traditional lending, we find, you know, people go in and they put in their application, and they feel like they're being told not to do it. They feel like the person that they're talking with on the other line of the phone or the other side of the desk is you know, has decided that this is over their head without a lot more information besides what they look like, maybe the amount of melanin their body produces, their gender, and their zip code. And there's a lot of promise with AI and really taking all of that out of the system. I think with all of these questions, especially as it relates to regulator scrutiny and policymaker scrutiny, people, institutions need to be able to explain their models. And I think that just gets down to the bottom of it. But I just fully agree. We're in a place where we can get more people safely into the financial services system, safely into their first home, safely into their first small business, in a way that's a lot more fair and sustainable than we've ever seen.
Christiana,
I'd also like to, there's also one more plug that I would like to make for performing actually, you know, less discriminatory alternatives analysis and how important that truly is. So, you know, one of the things that we often find is that, you know, when you go through that LDA process and you combine it with the explainability, what that does is allow you to identify additional variables, additional features that you can make decisions on. And what that can do is help you shift from features that have a lot of human input and then the possibility of bias being included to features that are similarly predictive but have less of the human bias in them. And the example that we give most often, and this is an oversimplified example, but it's, you know, in many credit models, the number of hard inquiries is included. And what we've seen is in many cases, what that will do is introduce more human bias because in, you know, in a discretionary situation, there tend to be more hard inquiries for people of certain classes compared to others. And if you replace that and you start using other features, and often these are like time on file features, and in many cases, you may have a lot more of those features that give you a more robust and powerful model rather than using that sort of tried and true feature that has been included in models for a long period of time. And so I think that's one of the values of really going through performing the explainability and then the LDA. You start uncovering some of these things that can, you know, improve the model as well as reduce the disparity.
Because Jana, you had mentioned earlier intentionality, and I wanted to ask if this is what you were talking about, that it's not that the model developers need to have like golden pure souls and they don't mean to discriminate or have any bias. It's that the call is already coming from inside the house.
Yeah. Listen, you know, I think, you know, this panel, I could go all day on some of these questions, but you know, we're in a place where, you know, the redlining, you know, making determinations of who gets loans where based upon their ethnic background, et cetera. You know, the last name, how that looks and sounds, you know, that legacy is very ingrained. And it's not to say everyone's doing it, but it's extremely ingrained. The legacy of who lives where and what zip code dictates this and that. You know, you just today, any of the panelists, any of the participants on this call, you go to one neighborhood, you see the Banks of America, you see the branches, you see a lot of availability. You go to another, payday lenders, pawnbrokers, bail bonds, you know, and it's all very concentrated. We're still very much mired in the legacy of discrimination, segregation, and racial and otherwise segregation and discrimination in lending. We're seeing it evolve in a way that's, you know, impacting people of the GLBT community, people with disabilities. Traditionally, we've definitely seen it in these areas as well, but we're seeing, you know, how this is playing out across the board. And Yeah, I think that's absolutely right. The call is coming from inside the house. It doesn't mean that everyone in this field is nefarious. It certainly does not mean that. I know American FinTech Council, my employer, we're a trade association. We've got several members that more than dozens upon dozens of members that engage in these questions and engage on how we can evolve with the times and evolve with understanding what traditional credit is, traditional credit power. And I think it's good that we're thinking about guardrails in AI, and I think it's good that we're talking. I would encourage companies to work with regulators and not run from them, because they're on this, whether we like it or not. They're on it. They have questions. They're going to be putting out regulations. Lawmakers are going to be are putting out legislation at the state level. We've got a lot of movement in California, New York, many other states. It's important right now for companies really to be focused on data and being able to explain. I think everything that that especially Larry just said in the past 5 minutes on this topic gets to what companies should be thinking about in terms of their interactions with regulators, their interactions with lawmakers, on being a part of the process that they're going to be doing anyway of putting out legal guidelines and standards. And we should embrace the intent of that, and embrace ways that we can inform them so that we're not inadvertently ending up in a system that stifles really, really good innovation that we've been talking about today.
And leads to what I believe Yana said earlier, getting people safely into their first house, their first job.
First business, first car. These are all really critical to other areas of quality of life and participating in system, building families, building communities. AI absolutely has and can continue to play a positive role in cutting out all the junk that and excess and there's a lot of unconscious bias. I don't think a lot of people think, I don't like this person, or I don't think most people actively think that in their head, but there is that element. Oh, no, they came in here with dirty shoes, or any of these pieces. Oh, she's got a lot of kids. Any of these kind of idle thoughts that unfortunately have played out. And so, again, on the transparency discussion, it's no one's really going to admit, well, no, I blew them off because they're Asian. No one's really going to admit that, right? So in terms of transparency, you can't get in someone's head, but we can get into the algorithm, and I think that's really important.
It sounds like I was seeing AI as a block to transparency because it is hard to understand, and now I've reformed my view maybe that if the AI can talk to me and communicate it to me, then even someone like me who's not an expert in this can see the decision-making process.
Your hesitancy is fair, and I think a lot of regulators would agree with you. We don't want to get into the, this is hyperbole, but like the Terminator movies, where AI is Skynet, and I don't know why Skynet did what it did. We don't control it. We don't want to get there with the transparency question. I think your hesitancy is very fair. People really, at the end of the day, need to look into their systems. We don't want automatic blind faith without testing. We've talked a lot about testing the models, and I think that's just excellent work that we're hearing out of Solas. And these processes should continue across the board. And we also don't want to have a blind well, I don't want to use the word blind, but we don't want to have an automatic distrust of something without knowing more information either. We really want to get in there, get into what these things mean. I think having an honest conversation about algorithmic bias is extremely important, because it is a thing, and it is something that the regulators are going to be very zeroed in on. But I think with the advice and guidance we've seen today, I think companies can be poised to, be in a place where they don't have to fear regulations, and they don't have to fear, equal violations and others. They can be in a place where if inquiries come, they can explain it. And I think, I don't think the Bureau is out to get people here. I think they just want to understand how these things work. And I think the more that companies can explain that, the better off they'll be.
Josh, do you agree?
Yeah, we're just almost out of time. I would agree emphatically, Yana, with you, and also, let people know that there is, or reiterate that there is competitive advantage that accrues to institutions who do this and do this well. Capco's most sophisticated clients are really approaching this as a way to increase market share, to bring on customers or address populations that may have been underrepresented. This is an opportunity as much as it is a compliance problem to be solved. And I think that is the heart of the Capco and Solas partnership here is marrying those two together, right? To do this, to take advantage of this core competency that banks must have going forward and do it in the right way. And I'll just reiterate real quickly how thrilled we are to be carrying this partnership forward. And we're seeing a lot of great interest in it.
Thank you so much for sharing your expertise. We wanted to pull up one more time so that everybody can see who you guys are. Thank you so much for answering my questions and doing it in a way that I could understand. We want to encourage folks to keep this conversation going. Some people might be watching this on the recording later. We will be sending out a link so that you can watch this later. We encourage you to share it with folks who maybe weren't able to be part of this conversation. I do want to say a big thank you to the folks behind the scenes who made this possible. Thank you, Alex. Thank you, Meg. Thank you, Colin, and anybody that I might have forgotten. And if you have any additional questions, we encourage you to reach out to our panelists. Here is some contact information, but there is no reason for, I see this as a big time conversation starter, even though we've already been talking about it. I think there is a lot more to say, and I appreciate you panelists for saying so much in such a short amount of time.